This panel is going to take a serious look about what do we do next? How do we restructure? How do we move forward with the right kind of mortgage financing world? And it's my pleasure again to have the opportunity to introduce the moderator of this distinguished panel, Chris Katopis. Chris is the executive director of the Association of Mortgage Investors, a key group that we're clearly interested in. He has a really rich background both in the private sector and finance, but also in public policy. He was a counsel for the House Committee on the Judiciary. He was head of the Congressional Relations Division at the Department of Commerce and actually clerked for the Federal Circuit here in Washington, D.C. So he brings a sense of that world that will have to take action, and at the same time a sense of the world that ought to be informing that action that we hope will be taken. Chris, the floor is yours.
Well, thank you very much. It's a great pleasure to be with you all this afternoon. I'm Chris Katopis of the Association of Mortgage Investors, here with a panel of some of the great minds in mortgage investing and finance. Very honored to moderate this panel. As a housekeeping matter, anything that I say today should not be attributed to AMI or its members. And I think what we want to do is hear from the experts. So what we're going to do in terms of the panel going forward is give each of today's panelists about 5 minutes to introduce themselves, talk about their backgrounds in government, finance, and talk about what is necessary to move forward, move the country forward in terms of restarting securitization, clearing the plumbing, and addressing a lot of the problems that we heard about this morning and we've heard about recently. So it's my pleasure to start with Dave Stevens, formerly of HUD, and now President and CEO of the Mortgage Bankers. Why don't you go ahead and take your 5 minutes, and then we'll hear from Alan Boyce from Absalon, and then Andrew Davidson of...
Andrew Davidson.
And then Michael...
My opinions are my opinions.
The best kind. And then we'll hear from Michael Waldorf of Paulson and Company.
All right, so I don't know if is this mic working? Yeah. So, look, it's a broad question. I look around this room, there's plenty of people who would have the answers, but as well. So here's my general view of sort of this kickstarting the housing market. The housing system is still extremely sort of dysfunctional, with extraordinary uncertainties that are overlaying any opportunity for recovery to occur. So there's, we talk about sort of fundamentals and technicals in any market environment. Let's just talk about a few of the key variables. One is just, in terms of economics, until the economy stabilizes in terms of home prices, I think anybody coming in and buying any kind of, mortgage-related instrument out of the U.S. housing system is going to have an extraordinary trepidation about doing so until they know at least the collateral isn't going to be declining in price. So, at its, fundamentally, I think we've got an economic flattening that we have to do. And while the news is getting better, and we see 52% of all in foreclosure is concentrated in 5 states, and one of them is California just because of its size, but 4 of them are judicial states. We're starting to see interesting outcomes state by state now in terms as we move towards a stabilized environment. But the real question then goes beyond that. So we have a system where there's a complete breakdown of trust. Consumers have their own, confidence issues that impact trust, but let's work through the rest of the food chain. Lenders are afraid to lend for fear of repurchase risk. That's the most significant impact. And the fact that there's, in many ways, difficult way to map that repurchase requirement back to any sort of causal factor. You have servicers who are moving out of the servicing market. Servicing values have backed up significantly. There are far few servicers in the mortgage market today. And a lot of that's due to this huge overlay of litigation risk, questions about MERS, questions about the functional operations of servicing, different state laws, different state attorneys general all involved in the servicing world, Department of Justice, OCC consent decrees. We have suits taking place. We've got Inspector General subpoenas actually coming through the Department of Justice for FHA servicing. All of this is creating, if anything, a retreat from the market, not a forward step. So I think it's worse now than it was perhaps even a year ago at this point in terms of advancement of credit and private capital coming in. Next step in the food chain is the investors. So if you're an investor today, you have a lot of risks. The QM proposed rule has assignee liability in it. And if the QM rule is violated by the originator, that could ultimately roll up to the investor. It has huge financial penalties associated with it. So if you're an investor, you're going to invest in this space called mortgage lending out of the United States, the risks of buying loans is a lot more risky here than it is out of the UK, for example. And so in comparison, getting that kind of investment in place is very, very difficult. And there's also intervention risk if you're an investor. You buy based on duration and yield. If policy coming out of the collective regulatory bodies of the United States can suddenly say, okay, we're going to refinance America and break all the rules, as it were, that's great because it helps a lot of Americans get the advantage of lower interest rates. But at the same time, it breaks the duration models by which you created that, way you invested in that mortgage-backed security in the first place. And ultimately, that's going to cause, again, trepidation about investing your own private capital at risk. The last point I would make is let's take the Redwood Trust example. Redwood talks about kickstarting the non-guaranteed market. As you all know, they're basically putting pools together of nothing but the sweet spot of mortgages, low LTV, highest FICOs, best assets. And they have a belief that if they continue coming to market with this product, ultimately a market will be created because interest will begin to occur. Yet they're valuing, when they do their own risk analysis, the rating agencies give zero value to mortgage insurance, zero. MI gets no value as a credit enhancement. And so anything over 80 is going to have limited value to get any upward execution as it relates to having a credit enhancement associated with it because MI has no value. No one's trusting the rating agencies anyway to begin with, and so everything falls back to the underlying requirement of having a fully explicit government guarantee on the MBS market in order for anybody to participate in it because of all this extraordinary distrust along the whole food stream and the need to get finalized certainty amongst rules, regulations, litigation risk, rules of the road on a go-forward basis that people will trust. So that's the problem.
Well, thank you very much. And I promised a very lightly moderated discussion because we have such great people up here. And this is a very savvy audience. But I wanted just to reiterate, Senator Corker this morning talked about how investors are on strike. And I think the Redwood Trust, just to give you a context for this, in the last 3 or 4 years, there have been virtually no new RMBS securitizations, with the exception of these Redwood Trusts, about 4 trusts going forward, and they're very small. And to reference the last speaker, these are all Kardashian, Mark Zuckerberg type of homes. These are not exemplary of what the market needs to go forward. These are sort of unusual securitizations, so they're really not what we need to move the market forward.
That's right.
Alan, do you want to talk for a bit?
Sure. I printed out a slide deck, and I'll refer to a couple pages. The return to private capital, in many respects, it's Waiting for Godot. If you guys ever read that book, I don't know whether you got it or not. I didn't when I first read it in high school. I reread it recently and sort of look at myself in the mirror and think I'm stuck in that book. Today, outside of the agency mortgage market, as Dave said, things are pretty much bust. The big banks are holding on to their high-quality jumbo mortgages. They like that customer relationship. They have big deposits with those customers, brokerage accounts. There's a pretty big bid out there that's being unfulfilled, though, for insurance companies and pension funds that like to buy that asset as well. And I think there's just a lack of plumbing to get it to them. On the flip side, the big banks are waiving in agency mortgages. Ginnies, Fannies, and Freddies, their holdings have more than doubled in the last couple years. A lot of that is due to lower risk capital weightings. I'll touch a little bit later on if we have time about that. But still, international capital rules are driving maybe non-economic decisions. Those big banks are also pulling out of the mortgage market, in no small part driven by the rep and warranty issues that Dave talked about. But secondarily, Basel III, in my opinion, miscategorized mortgage servicing rights. Mortgage servicing rights are an annuity. It's not a loss. And they categorized them in the garbage bucket where the Europeans put their tax loss carryforwards and other dud assets. All the big banks have multiples of their MSR limit already, and they are running away from that business. The first place they're running away from is not holding MSRs on customers' mortgages that they don't know directly, which means they're all shutting down or severely limiting their third-party origination channels. For you guys who don't understand exactly how the agency mortgage market works, 70% historically of agency MBS came in through wholesaler correspondent. That means all the medium and little banks and mortgage brokers in the United States have practically no outlet for their mortgages. Now, as the big banks are exiting, they're not exiting by saying we quit. They're exiting by just raising the profit margins there to dramatic levels. So the rate sheets that all the little banks and brokers face are at dramatically higher levels than what the big banks will offer their own customers. And you know what? This has been created by the fact that the U.S. government encouraged, created, and tolerates an oligopoly in our banking system. The U.S. mortgage industry used to be the most competitive part of our financial system. Now it may be the least competitive part. On the flip side, and you can look on page 5, you could argue that the housing bubble is fully corrected. If you look on that page, we're back to 99 levels on an inflation-adjusted basis. However, I tend to agree with the gentleman from Paulson that we may still have another 10% down in housing prices because there's a whole bunch of involuntary transactions that haven't been flushed through the system, and they will get captured in the housing price indexes. On the positive side, there are some green shoots that are popping up. I'd say there's 3 or 4 new TPO channels that are being set up outside the banking system. Unintended consequences of Basel III is the mortgage industry is reconstituting itself outside the regulatory space. There's a lot of REO to rental ideas. For some reason, they've all decided to call me and ask my opinion. I've seen some very clever ones, and the best ones I've seen are less REO to rental as rental to borrowers who have dinged credit histories with some option to own in the future. I think Andy will touch on this later. I tend to agree with most of Jim Milstein's points that the way going forward is to have some sort of originator first loss and the taxpayer not bear 100% of the credit risk. However, I think that cutting loan limits is the wrong way for the taxpayer to exit the mortgage risk. A year ago was when the TPO channels started cutting back on the higher agency loan limits. And if you look on slide number 4, you'll see my bubble graph of the impact on HPI by county in the United States. And there's a very clear correlation between the change in the loan limit and housing price indexes for those counties. On Wednesday, FHFA will release its MSA quarterly HPI index, and I'll update that graph and post it both on the Absalon and Columbia University websites. But I fully expect the outcome of our let's exit the taxpayer risk and allow some room for the PLS market to grow has resulted in only one thing. We drove down housing prices in the counties that were most affected. I think that the most important thing going forward to get the private sector involved is to take first loss insurance. I think MI is fake. I would never use the word insurance and MI in the same sentence because MI is not insurance. I've actually seen a couple guys who are setting up de novo mortgage banks with twinned insurance companies where the insurance holding company then wholly owns a Bermuda subsidiary, which Andy Davidson had a conference back in February, and that was the conclusion of the insurance experts. That's the best way to do it. But this is insurance that would pay upon initial delinquency and make the bonds whole immediately, not at final resolution. And I think the most important thing we need to focus on now is to fix the most obvious and lowest hanging fruit in our system, which is to allow existing performing borrowers who are already a taxpayer risk. So this is borrowers that benefit from a Fannie or Freddie guarantee, as long as they've been making their payments to and be able to get a refinance. I think HARP has had the goal of that. To date, there's been a bunch of restrictions, which I'll be happy to talk about later if people have the time. But still, the HARP 2 has still got a lot of significant restrictions, the most important being that a new originator faces rep and warranty issues where the same servicer does not. That has entrenched the oligopoly nature of our system. The existing servicers, especially the big banks, are offering dramatically worse rates, despite what Ed DeMarco said today, to those borrowers than other borrowers, and HARP 2 is going to reach a fraction of the people that it should. And this is important not just for those households, but the ability to refinance is the mechanism that makes Fed easing work. And until the vast majority of existing performing borrowers actually get to refi into today's rates, the Fed's monetary policy is the perfect example of pushing on a string. And they can continue to push and push and push. It will make inflation go up in China, but it will not get our economy going.
Great, thanks. What I like to do is just share a little bit of my vision for where I'd like to see or hope to see the mortgage market, let's say 5-10 years from now, and be a market that could provide $1 to $2 trillion a year of funding for mortgages. But before I do that, I want to just step into a little financial theory. And mortgages have a lot of different risks, but I like to concentrate on two of them. One is the funding aspect of mortgages, and the other is the credit aspect, or you can think of sort of the debt and equity components. From the funding side, we currently have about a $10 trillion mortgage market. And think, well, what's the source of the funding? So this is the actual money that goes to be used to buy the house. So when we have funding, it comes from the banks, but it's backed by deposit insurance or home loan bank advances. Funding also comes from guaranteed form through FHA and Ginnie Mae, or it comes through Fannie and Freddie guaranteeing MBS. So that's what brings the money in. We also used to have another form of funding called the AAA market. That actually provided a good amount of funding for a while, but is essentially gone right now. So the people who provide funding basically don't want to take any credit risk at all. They just want to say, I'm going to put up cash, I want to get that back with a low return. The flip side of that is the credit side. And the credit is who's taking the risk if the borrowers don't perform. And that can come in the form of either a corporate guarantee, so if like Fannie Mae or Freddie Mac provided a corporate guarantee, or if a bank owns the mortgages, it takes the risk directly, or mortgage insurance or FHA, those are all corporate guarantees. The other way of getting credit risk is guaranteed through something that's funded, so that you actually use the collateral to make sure that there's enough capital there to cover losses. So one method of that is, people talk about covered bonds. Well, we have something similar in the U.S. The home loan bank advances. You borrow from the home loan bank, but you have to put up more collateral than you borrow. The other is in capital markets, we have senior sub-transactions or credit-linked note. So the amount of credit risk we need, so if we assume relatively good loans with sort of roughly the capital the banks require, that's about 4% of that $10 trillion. So that's about $400 billion worth. And if we look at it now, how much do we have? Well, maybe we have maybe half of that in the banking system. The MI industry has virtually none. Fannie and Freddie never had much, but their $60 billion or so is gone. So we need to bring about $200 billion of new capital into the market to bear this credit risk if we don't want the government to do that. And just think, last week we had the giant IPO, right? All the news of the whole week was on one IPO. Well, we need about 12 of those if we want to recapitalize the mortgage market. That's how far off we are from having a well-capitalized mortgage system. So anyway, with that background, let me sort of sketch out my view. My view is that we should have about 10% in FHA Ginnie Mae, primarily for first-time home buyers or other financially capable borrowers, but otherwise have limited access to credit. And there, the government is providing both the funding and the credit portion. Fannie and Freddie, I'd like to turn into securitization cooperatives or utilities. There would be a government wrap on the senior piece, so the government would support the funding, but the credit risk would come through other form of capital. My preferred would be these credit-linked notes or senior substructures like Senator Corker mentioned. There should be some originator risk sharing as well. The cooperative should provide standardization and, probably most importantly, enforcement of reps and warrants against the other members of the cooperative. Then 35% could continue to operate through the banks. The banks can basically handle about that much of the mortgage market. That's probably going to end up being mostly 5/1s and hybrids, while the securitization cooperative with the government guarantee could probably continue the 30-year fixed rate, maybe some of the 10/1 products. In the banks, funding, once again, is through advances and deposits, so there's still government involvement even on the bank side, but the credit portion comes from the equity of the banks if they're properly capitalized according to our stress test. And then finally, it would be great if we could get back to a 25% fully private market, which would provide a variety of products. But that's going to require some new standardization. Basically, we had improper alignment of interests for risky loans. Our system actually worked pretty well for the super prime loans where servicing doesn't matter, reps and warrants don't matter, nothing matters because none of those loans default. But if you want to have some loans that have some risk, we need better alignment of interests. So overall in that plan, the government would still retain a significant component of the risk associated with funding, probably like 90% of the market, but I don't think anything else is really possible. But 90% of the credit risk, actually about 75% of the funding, but 90% of the credit risk would be borne by the capital markets. And I think that would be good to get that away from the taxpayer. So how do we get there? The 2 or 3 seconds I have left. First, I think we need to use the current structure that we have in the GSEs to rebuild this, bringing this private capital in. So I think that the GSEs could do these senior subordinated structures. They've done similar things in the past. They're done in multifamily now. They have these things called K deals. Freddie Mac did a deal called Moderns in the past. So we bring private capital in through structured transactions. We don't have to worry about counterparty risk, and we can start to build that $200 billion of capital and expertise that we need to bear credit risk. Once we have that going, we can then start to work on weaning the system off of the GSEs, transforming them in some fashion, and trying to bring the other components back along. Anyway, that's the 5-minute overview of probably a longer discussion.
Michael?
Thanks. I hope people in the back can hear me. Michael Waldorf of Paulson & Company. The views I'm going to give are my own and not those of my firm anyway, but it's obviously been informed by what we've seen in the market. We've never had an economic recovery without housing. And housing was at the center of the 2008 financial crisis, housing finance, mortgage-backed securities. And it's kind of understandable that it's lagged in this recovery, but we really need to do something better to bring it back online. It's my hope that whether we have a new administration or a second term of the same administration, that they and the Congress get together and they make it one of their top 5 things to fix mortgages, because I see mortgages as one of the things that was really left out in large part by Dodd-Frank. Sure, there's some stuff that deals with mortgages, but there's a lot more to do. Quite frankly, I think we need a housing finance bill, and I think this should really cover 3 things, which haven't really been dealt with by Dodd-Frank. Number one, what do we do about Fannie and Freddie? I think not just based on the polls we've just seen, but in general, I don't think there's widespread support for nationalizing them and having the government the dominant provider of mortgage capital for the United States. I think if you wipe them out, not only do you do a really bad thing for the real estate market, people won't be able to get mortgages, but you also lose the chance that the government has to get paid back its investment, as we've seen in AIG and TARP. The government can get its capital back, and personally as an American, I'd support that. So that kind of leaves a third option, which is to fix them and to restore the job of mortgage capital to the private sector where it belongs. Should it be regulated? Yes. Should it be backstopped? Probably. But these are details that need to be worked out. Let's put that aside for a second. Second, what do we do about private securitization markets? And I'll get back to that in a second because that's really the main subject of this panel. But the third subject that I think we need in a housing finance bill is what I call mortgage plumbing. Whether or not a mortgage is securitized, there are some problems we see in the system that clearly need to be fixed. I think we need national servicing standards. What happens when a loan goes bad? I think borrowers need to know what happens. I think investors need to know what happens. I think the government needs to have an idea of what happens. And I think we need to set up the rules based on all the experience we've gotten through a lot of hard work in the last few years, put them down and leave them alone. I think this ought to be done through regulation, not through litigation, not by AGs, but by somebody, if we're really dealing with the national mortgage finance market, somebody with national jurisdiction to say, here's what the rules are. We need national rules on servicing, national rules on mortgage transfers. You shouldn't have to play these games of who owns the note if you want to foreclose on a home. And dare I say national foreclosure standards, because if you're 2 years delinquent on a mortgage, as an investor, the person really shouldn't be in the home. And we need these systems to work, and they're not working. It's very clear they're not working. So I think we need a bill on that. As far as the private securitization market goes very specifically, I think Senator Corker had it right this morning. Mortgage investors are on strike. And there are 2 real pieces to this, one economic and one legal. And the economic is, it's not economic to bear mortgage credit risk. There are 3 types of risk you bear when you invest in a mortgage. You have interest rate risk. Interest rates go up and down. Okay. Second, you have prepayment risk, duration risk. When do you get your money back? If the person pays off their loan early, or if the house gets sold, you get it back sooner rather than later. Okay. And third is credit risk. And what we've seen over the last several years and for quite a while is an attempt to manipulate the price of credit. And these days you have the government stepping into the mortgage finance market and artificially depressing the price of credit. You see FHA, You see the GSEs in conservatorship. You see the Fed. You see various arms of the government doing whatever they can to push down the price of credit risk. And that's the government's prerogative to do so. On the other hand, what you're not going to do is you're not going to get people to bear credit risk for a lower price. When you have plenty of investors out there in the world who can put their money in a variety of places, they're going to put it in the place that gives the best risk-adjusted return. And if you're pushing down the returns, you're not going to get capital. And right now the government is providing all the capital, to oversimplify for a moment anyway. And if you want to get other capital in the market, the price needs to go up. And at a time when the Fed has pushed rates down a great deal, this strikes me as a great time to allow the spread, the price of mortgage credit, to go up. And I think this needs to happen. That's the economic side. Then we get into the legal problems in the mortgage-backed securities market. And having done a little bit of research, the funny part to all this is we've seen this movie before and we know how it ends. Going back to the 1929 crash, a lot of people know the stock market crashed back in 1929, but a lot of people don't appreciate the fact that the bond market crashed. Americans back then were invested much more in bonds than they were in stocks. And when the bond market crashed, it crashed hard. And bondholders all across America got hosed. And the bond market disappeared. And everybody said, what happened to bond land? Well, Congress created the SEC in 1933 with the Securities Act. And in 1934, when they passed the Securities Exchange Act, they asked the SEC to find out what happened to bond land. So the SEC came out with a report in 1936. I have a copy. It's part of public records. I'm sure we can make it available. It was written by two guys maybe you've heard of, William Douglas and Abe Fortas, later became justices of the U.S. Supreme Court. And they investigated what exactly happened in bond land. And what they found out anyway is that the underwriters and the securitizers pushed the system so hard it broke. The indentures that were written to govern the bonds weren't worth the paper they were printed on. The trustees wanted to be indemnified for everything and do next to nothing. The investors had next to no rights, and the rights they had next to no remedies. So 3 years later, in 1939, Congress passed the Trust Indenture Act, which is perhaps the most underappreciated of all the securities laws. And what it says is that if you're going to sell corporate bonds widely in the United States, it has to have certain minimum non-waivable protections for investors. And the trustee, who's appointed to look out for investors, has to do stuff. And this statute works so well that the guys in my shop who invest in high-yield securities, where occasionally things default, they don't know the statute exists. Why not? Because it works. Now, I could go back and take that 1936 report from the SEC, cross off corporate bonds, write in mortgage-backed securities, and it probably tracks about 80%. We know what happens. In the Wild West system, when every securitizer wrote their own custom documentation, and there were tremendous incentives to put bad mortgages into securities, and when they all blew up, and there were no remedies for investors, investors got burned. Not only are they not getting a return for taking on the risk, as we discussed, the risks are perceived to be very high. And if you want investors back into the market to invest in mortgages instead of other stuff, you have to give them comfort. You have to give them protections that are appropriate, that are structured, that are built into how a mortgage-backed security should work. You need a Trust Indenture Act for mortgage-backed securities. You need to give investors data with time to analyze it. You need to have a standard pooling and servicing agreement, so this way every time you want to look at a new security, you don't have to read hundreds of pages of legal stuff that may or may not work and you can't analyze. You need the servicing to be held at a certain standard, and if there are problems with the servicing, the investors need to be able to do something about that. You need real trustees to be able to monitor what's going on in the trust. And you need rating systems that work where not only does everybody get the same loan level data, but you have these things monitored as time goes on to make sure it's working the way that investors expect. These are the sort of checks and balances that need to be built into the system from day one to make sure they work. And they haven't been present in the market to date. These things are hard to work out. They're detailed issues. They require some work. And yes, they are going to cost money. And the costs of providing these services to give investors comfort need to be built into the economics of the securitization. You can't do these things on the cheap because cheap things fall apart and cheap securities fall apart when you push them hard enough. We've had tremendous complexity and we've had tremendous opacity. You need to give investors the tools to be able to figure out how much credit risk am I taking and am I getting enough of a return to compensate me for that risk. Because investors can play anywhere they want and put their capital anywhere they want, you have to give them the tools and the comfort to feel comfortable putting their money into mortgages, or the government is going to be the bearer of credit risk for for longer than we all want. I realize this is a lot to digest. Thank you for your time. We can keep the discussion going, but I think we need to move forward.
And we will. So let me start by visiting one of the assumptions of this panel and what we're doing. And I'm going to ask an overly provocative question. Often in housing finance and mortgages, we talk about ability versus willingness. So we all think that there's a interest in restarting private mortgaging financing. Is anyone opposed to this? And given that the Speaker of the House can bring any bill he wants to the floor and the administration puts out white papers, does our government really want to start securitization? Do you see anything otherwise?
I'll take a crack at it. I really don't think anybody doesn't want securitization. I mean, the technology exists. It's not going away. I think there are some people out there in the market who just sort of hope and pray that if things go on long enough, it'll magically restart.
We call this nostalgia.
So you assume the can opener, I think we heard about
Right.
earlier in the day. These things don't happen by magic. I think we need to take real steps. And
It's funny. I don't think when you think about the dialogue, and there's some folks I see in the audience who've talked about this in the administration in the past, but there's not a whole lot of talk about securitization itself as an end or as a critical component. Let's talk about credit risk management, safe and responsible lending, bringing private capital back in. There's never this differentiation about how how we must have a securitization environment versus a whole loan environment. And it's an interesting point to bring up because it changes the whole flow of capital and the structures that you need when you commit to that.
Well, Michael, I'm sorry, do you guys want to jump in on that?
Well, if we don't have securitization, we need a banking system that's way bigger.
Right.
Like way, way bigger, and we're already having a debate over whether our banking system is too reliant on very large banks that are too big to fail.
We should create a savings and loan system that takes
we need a European banking system.
yeah. Canadians good too.
Well, I'm not an expert, I don't pretend, but it's my understanding that in Canada, the government does bear a very large share of the mortgage credit risk at the end of the day. And I think out of our overall concern for systemic risk, we want to diversify this as much as possible. Securitization is a way of diversifying risk to people who decide that they want to hold it. And I don't have to hold a whole loan, and I don't need to hold a pool of loans. I can own an interest in a pool of loan. It opens up the capital markets to smaller providers of capital. And you have the larger ones anyway, but unless you're going to concentrate the credit risk, you just can't have all the mortgage risk held by the largest players.
And as many of you note, you can look at some of the other foreign banking systems. They do not have 30-year mortgages in those countries. So going back to the whole, do we want to have a 30-year mortgage policy in this country?
So I think what's gone on so far in the policy, especially if you look at Dodd-Frank, was putting Band-Aids on an old broken system. I think what Michael brought up, and I think what really needs is to rethink how this system should work, top to bottom. And maybe that's not, what Congress is best at doing. And so, maybe the industry needs to sort of reformulate its thoughts. But what the system we have now basically grew out of one-to-one trading between two different thrift institutions.
Right.
And it worked pretty well for a one-on-one system. And then that was sort of transformed into securitization. And what we really need to do is say, no, if you start from thinking about securitization, how should this be structured? And you have to get down to the county clerk level of how actual mortgages are registered.
So based on those comments, no matter what the issue is, finance, technology, trade, you can almost say that there are 4 levers you can pull. You can have industry best practices, you can have Congress intervene, you can have agencies do things, and I understand FIFA has released its strategic plan for the next several years, or in the courts. And for people who've worked in all 3 spheres, somehow the courts are efficient because whoever you are, if you go to the Supreme Court, you're an inmate or you're a big bank, you get 30 minutes to argue. All right, healthcare was different. But there's a very efficient process in the courts. But how would you guys, and there is a Trust Indenture Act in the federal courts right now, and I don't know if you can comment on it, but generally speaking, which of the levers should be pulled first and what process should move forward? Maybe they need to move in tandem.
Well, personally, I think industry best practices. I've heard people ask up here today, why can't industry just do it on their own? Well, they've been trying for 4 years. And without getting into the details of the discussions, of which I have not been an active participant anyway, Project Restart by the American Securitization Forum has basically gone nowhere because you see a standoff between the sell side and the buy side, by my understanding. And I think we have, well, let's just let the industry take care of it, which is responsible for the old structures that we've seen fall apart under massive stress. I think we need standardization. One of the things in the 1936 report was the idea that when you have a very concentrated set of underwriters and a very diffuse set of investors, when a deal is brought to market, you don't have a negotiation between investor and underwriter. You don't have a negotiation between buyer and seller. What happens is, because you're atomizing all the financial assets, you have a lot of different pieces you can sell. And if you're an investor and you say, I don't like terms X, Y, or Z, you can be presented with the question, well, maybe I'll give you 5 more basis points. Do you feel better now? Or if you don't like it, I'm going to go to, in the old days, it was the dentist in Des Moines. Now it's the Norwegian pension fund. What you have is the marginal, the least sophisticated investor in the market setting the terms for the whole deal. And what you have when that's the dynamic is the race to the bottom. And I think we've seen that. I would probably...
It is interesting, though, when you talk about standardization. I think everybody wants a national set of servicing standards, for example. I think a standard PSA makes a lot of sense. But that's outside the Beltway. Inside the Beltway, we've got, everybody's in servicing. One of the hopes I had out of Dodd-Frank was the CFPB would take ownership of their responsibility and decide that they're going to own this consumer protection on servicing standards, and they would put out the set of servicing standards. But that's not the case. They've promised to put out a set, but it's not stopping everybody else from putting out their own servicing standards, let alone all the states. So, it's interesting. The government we need to fix the problem is also the same government. It's not a political statement about a party, because it's everybody. All these agencies are all involved, and I think it's adding to the sort of morass of piling on impact that's causing the delay in any recovery, and even a normalized sense, if it kept the system the way it was operating now.
Well, this is why I really think you need leadership. I think you need a national consensus. I think you need people to stand up and say, we want private capital providing things for mortgage and providing capital for mortgages. And because of that, we recognize we need certain things, and we're going to set the broad brushstrokes in Congress, and we're going to let regulators who really understand the details of mortgages set what servicing standards are, for instance, set what data should be provided to investors, set the mechanics of how these things should work, and they should change infrequently. But because Congress acts very rarely, it needs to be very top level. It needs to assign responsibility, take everybody who deals with mortgages in a room and say, you're responsible for this, you're responsible for that, and everybody else back off.
Right. I thought that's what Dodd-Frank meant to say by creating this new regulator, but it hasn't. It's not clear in terms of how that's been implemented right now.
I'm from outside the Beltway. I think Dodd-Frank tried to say a lot of different things, and I think there was a lot of things going into CFPB, not just mortgages.
So I'm hearing that Congress is probably the best lever to pull for some of the solutions that you are offering. And I'm wondering, what is the low-hanging fruit? We have Senator Corker was here. He has a bill. Senator Garrett's staff's here. They have a bill. There's a suite of bills as part of the president's to-do list from Senators Menendez, Boxer, Feinstein, Merkley, Reed. I mean, what's the low-hanging fruit, and is any of that helpful, or do we need this big omnibus?
I think there's some things you can do. Again, once again, if you're talking about crowding out private capital, we have money and we have legal structure. And in terms of the cost of credit, a very easy thing to do is to direct FUFA or allow FUFA to raise the GSE cost of guaranteeing mortgages closer to market levels, if not to market levels. I think we ought to have FHA do the same. I think we need to have a recognition that this is a market. If we want the market to function, we have to let markets set rates. And if the Fed is keeping base interest rates very low, now is a great time to allow the price of credit to be, to allow credit to be priced what it should be in a market.
So on the multifamily side, that's basically exactly what's going on at the GSEs, right? So on the Freddie Mac side, they place all the credit risk of 15% credit enhancement in the private market. That's priced at the market level. They basically know approximately what that cost will be. They add on to that so they can make their profit. So that's, but the government is still guaranteeing the senior piece, and so they're able to provide the funding portion on the 85% at 50 over LIBOR, as opposed to if the private market did that with all the uncertainties, that would be like 100 to 200 over LIBOR. So, and I think we should be doing the same thing on the single family side as well. Let's find out where the private market would take on a good chunk of the first loss, and let's set the guarantee fees accordingly, and let's get to that point. And then if you can sort of work out a way to make the funding portion reasonably efficient and standardized and secure as well on the private side, let's do that. But I don't see the AAA market coming back to be $1 trillion or $2 trillion anytime soon due to all the distrust. On the credit risk side, it's fewer players who can negotiate more directly with the GSEs and decide if they're satisfied or not satisfied.
I think that's the
with
cart
what they're
before. I
going
think that's a cart before the horse approach. Because if you try to price to private capital levels right now, the private market has a lot of things that are inhibiting their investment in the mortgage market right now. I mean, one role the government has traditionally played is its continuous presence of capital during economic recessions. We saw it in the oil patch crisis when 50% of Oklahoma's loans were going to FHA, even though they had a national level of about 13%. They fill the void because they provide continuous presence, and that helps the first-time home buyer and people who don't have necessarily means. So if we now say GSE should raise price to whatever the private capital trading level would be for that price, in today's market with all the other uncertainties from regulatory litigation, lack of rules, lack of common standards, you're going to build all that additional pricing like uncertainty premium, and the GSEs then match to it, and all it does is constrain the access to affordable housing finance for everybody.
I'm not saying price the full loan to its private market execution. I'm saying price the credit risk portion, which is 4 or 5% of the junior piece that should trade at 12, 15% at most. If we look at where the maiden lane 3 trades are coming out, they're not at like outrageous returns for bearing the credit risk. I agree that you're not going to get the funding investors back into the market. So for the 90, 95%, which is the funding portion, that needs to rely on the government guarantee for a long time until we get the system stabilized and get the assurances that the private market needs. But I think there's specific credit investors who could start to add 10, 20, 30, 40, $50 billion worth of capital in to bear the G-fee part of the risk.
We could do this on a partial basis, on a trial basis, to see where is credit trading, without turning the whole market upside down by all of a sudden raising rates for everybody at one time.
Redwood's doing it, right?
Yes.
Right.
Alan, do you want to talk about some of the refi proposals that are pending and whether they're relevant for this?
Well, I think to go on the bills on Capitol Hill that have a chance of success this year, I think Boxer Menendez has the best. And that bill stayed clean so far. It has extended the HARP date by only 1 year. And I think they have an agreement that any reharping in the future can only happen to loans that are 2 years seasoned. I think that gives plenty of protection to callable bond investors, that their callable bonds won't refinance immediately. Just to refresh everybody's memory, we've had refi waves in 86, 87, 92, 93, 98, again in 01 through 03. And in that time period, without any help from the Federal Reserve, the bond market didn't go on strike when prepays were much faster than modeled, and the mortgage market expanded in size. So this time around, we're not talking about cash-out refi. We're talking about same balance refi, only for people that have made the payments. And the Fed's announced that they're more than happy to recycle all their holdings. The Fed happens to own most of the MBS that would suffer from a 1 year pulling forward of the HARP cutoff date. So I cry crocodile tears for all the bondholders that are complaining loudly about how badly they might get screwed out of this.
Well, that's interesting.
Just to put a fine point on this, they own callable mortgages. The call options have been prevented from being exercised by 3 actions of the U.S. government. First action was they're allowing the GSEs to impose loan blockers, LLPAs. They're created for no other reason than to prevent their own portfolio from prepaying. Number 2, they took the most competitive part of our financial system and made it an oligopoly, which is very effective at exercising oligopoly pricing. And last but not least, this misnegotiation of Basel III has raised mortgage rates for everybody. And the insanity of our fix to the mortgage market is driving it out of the regulated space. Has got to end. But the flip side is the green shoots are coming from non-banks.
Let me just say something, and I'm going to say spoiler alert. AMI and its investors have put forward documentation about how to restart securitization. We think we could do a 6-page bill addressing transparency, standardization, removing the servicer conflict of interest. We could go on about what should be on that list. One of the things that came up today many times is investors want, there's a trust factor. There's some covenant with the government they seek. And it's interesting that you're pointing that out because for some investors, it sounds like the goalposts keep moving. And I guess we could debate that, and you have a report
In this
to
case,
that.
the football field was shrunk for the investors, right? They took the kickoff, and all they had to do was move the ball 1 yard to score a touchdown.
The only thing I'd say, Alan, is just with all deference to our best friends, the GSEs, if you assume they were underpricing credit risk to begin with, they added the LLPAs to essentially price it where it should be. You could say,
No, but that's not correct. If they want to price it where they want to get it, then they should charge higher G fees. Those LLPAs are loan blockers. Come on, Dave. You worked at Wells Fargo. The way secondary markets create rate sheets is it's money in versus money out.
Right.
And that raises the money out bar huge and raises mortgage rates way more than you can possibly imagine unless you've worked on a secondary desk. And that is a commonly misunderstood perception that the GSEs and FHFA continue to push out there in the press and argue strongly that it's a tax that they want to collect. It is a tax to prevent, not a tax to collect.
Alan, let's throw a difference here anyway. When we're talking about what investors will put up with and not put up with anyway, there's a very big difference between telling an investor who expected to have his money at a given rate for 5 years and they're only getting it back, and they're getting it back after 3 years. You're getting your money back early. I mean, that to many investors is a reasonably acceptable risk and part of the game. There are prepayment options, and you got your money back sooner. That's a very different risk from changing the servicing standards when you say, well, because we're not going to let you foreclose on a house for 2 years, you're going to suffer bigger credit losses, and instead of getting 100% of your money back, you're getting 80% of your money back. I mean, they're two very different types of risks here, and by my understanding, investors are very sensitive to the second relative to the first, which is a lesser concern.
Or to a corollary to that is a mortgage originator that finds out 4 years later that the delinquency was pushed off for 2 years, and then when the final losses totted up, the MI declares that there was never an insurance policy in force, and the entire loss is put on the original servicer in the form of rep and warranty liabilities, and the loss has been tripled by the time delay, and they were never accounted for these rep and warranties for like clerical errors, which is like to defend the big banks. One of the reasons they're fleeing is...
But it's not the big banks. This is they dump it to these guys who sold it to them. So this
right,
this rolls straight downhill to the small.
But the big banks catch it first since they service most of the mortgages.
Right.
Andy, do you want to weigh in?
Yeah, I'd say, I think it would be good to have more borrowers be able to refinance to lower rates. The problem we've had is that every time these come in as government programs, they tend to distort the market or delay other actions for 3 to 6 months as it takes time to create the new rules, implement the rules, change the systems. And so if there's a way of achieving the same goal without as much disruption, I'm all in favor of it. I agree that the investors should bear the prepayment risk. But the question is whether or not the system should bear the disruption.
I'm pleased that we have a little extra time on this panel, given that the prior panel ran long. Let's open it up. If any of you have questions in the audience, happy to entertain them. People with mics are lining up in the aisles. Any questions? North Carolina. You're the first caller.
Hi, I'm Yannicka Ratcliffe. I'm hearing a couple things, and I don't know that they disagree with each other, but I've kind of heard a couple conflicting or themes that are in tension throughout the day. One, that the GSEs are charging too much, and one, that they're not charging enough. And in this panel, you make the point
Goldilocks syndrome.
that there should be some price discovery of what the private sector, which in theory is some kind of a benchmark, it may not be right either, but that should be discovered. And I feel like that work has potentially been done. I mean, have we had any insight into really what the private sector would want as a G fee to take that first loss position in today's environment?
Part of this is a question of volume and liquidity to get a real good price match. But go,
Right.
Andy.
Yeah, I'd say right now there's no real transaction that you could point to that would say where the private market would take, let's say, the first 4% or 5% of credit loss. And so we have that in the multifamily market, but we don't really have anything in the single family. Even like the Redwood Trust deals, they didn't sell any of the junior classes, they just sold the senior classes. So we don't have that. As far as the G fees, my view is that with home prices relatively stagnant and unemployment relatively high, there's a lot of credit risk. But a lot of it has to do with how much capital do you think they should have to hold. And at the amount of capital they held before, they were overcharging, but they weren't holding enough capital. If you get to what we think would be the right amount of capital, which would be 3 to 5%, they're probably undercharging. And then whether or not they should be charging the same amount across the board and cross-subsidizing or loan-level pricing, that's a separate debate.
I would dispel the notion that the private sector knows how to price this stuff. If you look back in 05 through 07, both the GSEs and Ginnie Mae lost market share to the private sector. And back then, the FHA was charging very small insurance premiums,
Right.
which Dave did a really good job of correcting.
I hope they hold on to them.
And the GSEs were, you could negotiate with the two of them and drive your G fee down to 10 basis points if you had a lot of market share. And the private bond market underpriced that. People did conventional loan deals that looked like a Fannie 5, except without the wrap, just to save 10 basis points. There was a lot of that going on. The people who bought them now regret that greatly, because you've got double-digit delinquencies going on. But the private market, if anything, was even more pro-cyclical than the GSEs.
Right.
So I just want to be a little careful when we say that somehow the private market knows better.
But in some sense, it doesn't matter. As long as there's enough capital in front of the government guarantee, it doesn't matter if the private market misprices. That's then on the return of the private market players. The problem is when you have something like the GSEs or the subordinated structures we had in subprime or the CDOs, where there isn't actually enough capital in that system, and it underprices and then takes a loss that eats through all its capital and then creates the systemic problems.
We got Bernanke talking all day long about how we need housing to recover, the credit's too tight, not enough people are getting access to home ownership, and we're talking about raising prices on the GSE paper. I continue to worry that the one lesson we've learned from HARP is the way you get everybody to refinance is you limit the impediments to borrowing for good, quality, responsible families. Limit rep and warranty risk, and you streamline documentation standards. On the other hand, on the purchase side, we're just piling on. Endless risk to new originations. It's tightening credit. The senior loan officer study that the Fed just released in April clearly shows that's even getting worse, not better. And so everything we learned from HARP is completely being defied in policy for the purchase side, and it's not impacting the wealthy, not the 1% of America, as it were. It's impacting anybody on the margin who wants to gain access to home ownership per the last presentation. My sense of this thing is we got to focus on stabilizing the housing sector first and foremost. Let's do that now. And then let's talk about how to engage the private capital markets back in. But I don't see private capital coming back in as long as there's still economic uncertainty at a base level above and beyond all the other variables, unless you trust every counterparty who's providing that credit guarantee on the PLS side. Because, that's...
I think our firm would probably be one of the last to say that the private market always gets pricing of credit risk right. But by the same token, anyway, if you get the data out there, if you give people, protections that the data is right, if you continue to give people data real time, they can analyze the risks they're taking and take their lumps fair and square, and not let them put back mortgages for clerical errors back to the original lenders, and get some sort of rough justice to make the system move forward from there. The private sector, because it is their capital, they have alternatives. They don't have to play in the mortgage market. The government may decide that housing is important enough that we're going to subsidize credit risk in the mortgage market, and as long as that happens, you will crowd out private capital, because the private capital will go elsewhere. They don't have to play in the mortgage space. But by the same token, anyway,
and multifamily that you used as an example earlier, that's a recovery market. You couldn't find capital for the multifamily market a couple of years ago, zero, and now there's interest, because the core economics of multifamily housing has improved so dramatically.
It's economics of the underlying. It's how much of a return you want to bear that risk. It's a question of what sort of risk am I taking because am I getting the right data? I mean, when you have a building or a handful or 5 buildings or 10 buildings anyway, it's relatively easy to check the numbers and say this is what the numbers are. This is how much money is coming in. Can they service their mortgage? Yes or no. When you're dealing with a pool that has several thousand borrowers, I think experience is clear that you need to have more checks and balances than you've had in the past.
I think if you think about mortgage rates, mortgage rates are incredibly low right now. And if you look at, affordability index, it would say, oh, homes are the most affordable they should ever be. Home prices should be soaring. Everyone should be rushing out to buy a new home. And, even if home prices were going to fall 10%, if affordability is like at 150%, people should be willing to take that risk. The problem isn't the mortgage rate. It's the terms that you get the mortgage on, right? So it's the amount of down payment and the lack of equity that borrowers currently have. And, so through Fannie and Freddie, the average LTV is now like 75%. So clearly, as on purchases. So clearly that's not going to help, bring down the cost of home ownership. So really the only place we have that, can help the housing market is really through FHA currently. And so anyway, so I don't think we should focus as much on the mortgage rate as whether or not we can expand the credit box a little bit and sort of bring some more people in. And it may actually mean at a higher mortgage rate, but you're going to reduce the amount of equity that people have to put up.
Let's go back to the audience. Jim?
Yeah, Andy, could you explain a little bit more, describe to the audience your co-op model, maybe compare it to Senator Corker's idea about devolving, out of the GSEs. What relationship would your co-op model, for example, have the GSEs, and also whether or not there would be a need for some kind of a federal regulator, sort of cop on the block, to make sure everybody's playing by the same rules?
Right. So the idea of a cooperative is, something like a DTC, Depository Trust Company. We'd have the originators own a utility. The utility would create the security, set the standards for servicing, purchase and sale agreements. They would bring in there would be an external government guarantee for any of the bonds that were wrapped, but this entity would be regulated by the government. So just as DTC is regulated.
One entity or multiple?
I consider go back and forth. I thought, we had 2 now. It would be nice to continue with 2. I think having 10 or 20 originators is bad because that creates race to the bottom rather than positive competition. Because what we need is standardization. And so one of the ideas of a cooperative is that you force the monopoly profits back into the chain somewhere along the line, right? So
it would be owned by the originator.
Right. The reason I want it owned by the originators, you could have it owned by the issuers, but it would bear the rep and warrant risk. And so if one of the loans went bad, all of the originators would be on the hook rather than, going out of business and that risk is gone. So that some combination of originator capital, good enforcement of reps and warrants, which obviously would need some government oversight, and then bring in some additional private capital so that we have some other way of bearing that risk, is the basic idea of the cooperative. But it would be a regulated entity that would try and establish rules, but those rules would have to be approved by a regulator.
Yeah, I agree those rules will need to be established by a regulator because I think if investors see the securitizer set the standards, once again, you're at the risk of getting to the same race to the bottom that you saw before. I'm also personally not sure how well it would work. I know I wouldn't want to stand behind somebody else's rep and warranty that alone was, that good. If they were only if there were 10 parties in the cooperative, and I bore 10% of the credit risk, I could somebody saying, hey, if I only need to bear 10% of the risk that my loans are going to go bad, it's better than bearing 100% of the risk, so I'll just run it all through the cooperative and hope I can put more bad loans than my partners.
Right, although I think a well-structured cooperative can work. In the world's biggest performing non-government guaranteed mortgage bond market, a co-op for all the little banks has about 50% market share. And they came up with a clever set of risk sharing. That's from the tiny country of Denmark. There's actually more performing PLS in Denmark with 1/60th the population of the United States than in the United States right now. It's also the only other country in the world that has 30-year fixed-rate mortgages. And to touch on Andy's point, they cleanly separate credit risk and interest rate risk at birth. So they didn't have anybody that wanted to prevent refis. All the guys holding the credit risk really wanted their borrowers to have lower payments.
Okay, I think we have time for 2 questions. Gentlemen?
Josh Wright, New York Fed. I don't know if I missed this point, but you were talking about how there are serious challenges for industry to undertake industry initiatives to provide some leadership here. Buy side and the sell side can't agree. To any of the panelists, what do you think the prospects are for in the near term or in the medium term that changing and industry actually taking some kind of initiative?
I'm not aware of anything suggesting that things might change in the next year, having tried for Ford to get to a consensus until now.
I think until the originators have loans that they need to sell, and so therefore forced to compromise with the investors, it's hard to get things going. Right now, and then also everyone's suing everyone. So once you start suing each other, on one hand, it's very hard to sit down in another room and say, can we compromise on all these other issues? So I think it's, I think it'd be nice to try, but I think it's going to be slow.
I think that it's probably not going to come out of ASF because that's where the most acrimony is between the issuers and the investors. I'd say that maybe the Mortgage Bankers Association's got a better chance than anybody else to try to
I think
piece those standards together.
I think there's opportunity, but the breakdown is pretty severe. That's why I started talking about the lack of trust throughout the system, because I think fundamentally that's what's separating the ability to get progress and move forward. I mean, we can get together and vet the various proposals, and I don't think the co-op proposals really, there's a lot of similar proposals that make that a reasonable outcome. I think everybody could probably agree we just got to get together and do the hard work, and then ultimately need policymakers to buy off on it. So
remember, Freddie Mac was the co-op for all the little thrifts until they demutualized, and it worked really well.
And I would just echo what Dave said. AMI is a trade association that's working with regulators, working with the Hill to try to move forward, standard setting. And as I said, AMI believes a 6-page bill on servicer conflict of interest, transparency, recourse would solve a lot of the problems that we've talked about today.
Problems, Chris, any 6-page bill starting off ends up being 162 pages by the time you're done.
Journey of 1,000 miles. I think we have time for 1 or 2 more quick questions before we wrap up. Anyone? Well, are we time? You have a question or? Yeah.
It's Kent Hughes at the Wilson Center. 2 questions, in fact. One, in an earlier panel, there was a reference to your grandfather's down payment, 20%. What would be the impact?
30.
Well, let's 20%. I'm happy to stay there. 20%. What would be the impact of going back to that kind of standard? And second, no one's really talked about the potentially dynamic role of the home equity loan. That in this crisis, as the home equity market has largely disappeared, you see a sharp drop in the formation of startup companies. And many individuals, they went savings, credit cards, and then home equity as a way of getting that startup off the ground. Is there any role for housing to continue to play that sort of basic financing for the startup world?
So let me just start off with the down payment piece, because I make a disagreement down the food chain here, but down payment is the single biggest barrier to home ownership. Of the 12 to 15 million households that are going to be created over the next generation that the Joint Center predicts, it's going to be heavily predominated by Latino borrowers and first-time home buyers. And down payment, unless you grow up in a family where you have large inherited wealth or you have a lot of net disposable income, you can end up creating a sort of separate but equal housing society as a result of creating bad rules. If you qualify people well enough, loans should perform relatively the same unless one borrower gets in distress and doesn't have the equity to sell. But in the end of the day, just take Q3 2011, new purchase transactions in this country, 53% were to Hispanic borrowers. 53% of all unique first-time homebuyer transactions in Q3 by the Census Bureau were Hispanic. 80% of all Hispanic homebuyers in the last year, according to HMDA, got their mortgage through either FHA, VA, or USDA, through a Ginnie Mae product, because the GSEs have this big down payment barrier. And so what we have is we have a society where we're driving first-time home buyers, and people, because of disenfranchisement economically through generations, are now being forced down one path for home ownership access, while another set of wealthier borrowers, as it were, with bigger down payments, get access to a broader array of products. And yet, fundamentally, if you deal with the ability to repay issue and safe and sound underwriting standards and products, you can solve for this without a significant focus on down payment. No down payment may have issues, but you can get good performance out of a low down payment borrower if you meet the rest of the qualification standards without creating a housing finance system that says, Wall Street will get loans for themselves, and the middle class America and first time home buyer market is either going to get an FHA program or go to a payday lender. So I think in the end of the day, we've got to be really careful about the outcomes, focusing on down payment. It's critically important to the whole dialogue of home ownership right now.
I think that there's ways to help people save money for down payments. Germany has 40% down payment requirements and very conservative LTV, so in many respects it's a 50% down market. But they have a tax advantage savings program where you have to make regular payments. Now in Germany it would be it's 5 years before you can qualify for a mortgage. But if you just did that for 2 years, and people had to make the payments on the same day every month, you're really going to sort out the responsible borrowers who are most likely to make their regular mortgage payments from the dross. And I think you could maybe
I wouldn't eliminate,
get an extra 5 or 10% down payment that way, and then combined with better underwriting.
I wouldn't eliminate tax policy as a way to get there, but I think I'd want to challenge the data. We can talk about that offline. Or we have an expert in the audience I'd point to, but I won't pull him out right now.
Right, but I'd much rather see the taxpayer subsidy go to saving down payment than borrow more money.
So I finance my company through my home equity line of credit. So, but despite that, I really think that we should change the law that if you make a first lien and you make an 80% first lien, that no one should be able to borrow more against that same property without your approval. Now, if you borrow 20% and you want to go up to 50%, that's fine. But it really doesn't make any sense that the first lien investor takes on more credit risk because of something that happens subsequently that they don't control. I do think that, that there's no problem with high LTV lending. We've been doing it for, decades and decades in this country at 90 and 95. 97 is sort of pushing the limit, especially, if it's not really cash. But what you really need to do is underwrite completely differently for 90 and 95% than you underwrite for 70 and 75%. And now we're in the bizarre situation that we're underwriting 70% loans like they're 95% loans. So we have the whole thing, socially totally backwards.
Right. Do you have a second question? No, I got them both. Okay, well, 2 items before we adjourn. First, one of the panelists mentioned the Trust Indenture Act report of 1936, which is great reading. It's actually on the AMI website, and scholars will be interested in it because Abe Fortas and William Douglas are 2 of the SEC commissioners who helped author it. So it's on the AMI website if you're at all curious. And as a last wrap-up question, let me ask the panelists, it was a Danish physicist, Niels Bohr, said, prediction is difficult, especially about the future. So when we reconvene a year from now, what do you think we will have seen transpire out of Washington industry best practices and restarting private mortgage?
A year from now? I think a year from now. I think the rest of this year, we've got 100 plus, more than 100 rulemakings from Dodd-Frank that affect real estate that have to be implemented between now and January. I think we'll be dealing with the outcome of a whole bunch of rulemakings, and we'll have a new Congress, whoever wins, that's going to come in heavily energized to throw all sorts of legislative maneuvers at our industry. And so I actually could see, I'd love to have an optimistic statement, but I could see us in a sort of greater state of confusion a year from now because it'll be May of next year in a new world.
A good excuse for a sequel to this conference.
Yes, yeah, come get a bigger audience next time. So,
well, President Obama announced in the second half of last year that his biggest regret was not addressing the housing finance issue head on. So if he gets reelected, he's going to pile on, and he'll probably have a friendlier Congress. And I can't imagine if Romney get elected that he's going to ignore the thing that's hurting the economy and preventing monetary policy from working for very long at all. I think he'll jump on it too.
Bohr's scientific competitor was Heisenberg, who said, either you know where you are or you know where you're going. You can't know both, and I think that's where we are.
Yeah, that's good.
Maybe neither at this point.
I won't pretend that the next focus of the Congress isn't going to be taxes walking into next year, but I'm hopeful that we'll turn our attention to mortgage reform, and we'll have a lot more ideas to discuss at this time next year.
Well, thank you all. Please join me in thanking the